Welcome to the yield tree here. We don't chase noise, we measure foundations. If you are looking for a celebration party, you've probably come to the wrong channel. The numbers flashing on screens this week. Gold touching $5,000, silver surging vertically past $100. Within hours, this isn't cause for celebration. This is an alarm. This is mathematical inevitability manifesting in real time. For years, we've been whispering about the fragility of the paper derivative system. And today, the market is screaming to confirm it. What we're witnessing right now in January 2026 is not a so-called bull market. That is a word for tourists. What we're witnessing is a repricing of reality itself. Let's peel back the surface and see the essence. Look at the charts. Gold futures $4,983.1. Silver futures $103.26. Mainstream financial media Yahoo Finance, CNBC have clearly lost their composure. They're telling you this is unexpected. They're arguing that $5,000 was supposed to be a year-end target. But it is January, and the timeline has collapsed. Why? Because the market has finally realized that sovereign debt structures are insolvent. If you only look at the dollar index, you'll be misled. Sure, it dropped to 97.46, hitting a new low since last October. But that is just a race to the bottom among fiat currencies. The real scoreboard is the Swiss franc. USD/FHF is just one step away from its all-time low. This is the core signal. Europe's last honest fiat currency is rejecting the dollar. This isn't just a technical breakdown. It is a structural fracture. A rebellion is happening in the bond market, and it is not speculators. Leading it is sovereign nations. Danish pension funds are openly dumping us treasuries. Nordic capital is reassessing exposure. The deadliest signal comes from India. Their US Treasury holdings have dropped to a 5-year low. Connect these dots and you'll see this isn't a simple rebalancing. It is an evacuation when the global South and Nordic prudent capital exit simultaneously. The only buyer left is the Fed. This is textbook fiscal dominance. It means the currency must be devalued to keep the government running. The market knows it well. That is why gold is standing at $5,000. It is not that gold has become expensive. It is the denominator, the dollar, whose purchasing power is evaporating. This is the devaluation trade. Goldman Sachs is still advising private investors to hold until 2026, but the smart money stopped selling long ago. They're watching the gold-silver ratio for the first time in 14 years. The gold-silver ratio has been compressed to 50-1. Silver isn't just playing catch-up, it is awakening its historical memory as money. But unlike gold, silver has a dual personality. It is money, but it is also the lifeblood of industry. This shifts our gaze from monetary policy to a more brutal physical reality. While all cameras are focused on precious metals, a more dangerous deficit is forming in the backbone of industrial civilization. Look at copper, $5.94 a pound, approaching all-time highs. The narrative you hear is I demand or data center construction. That is not wrong, but it is just scratching the surface. The real problem isn't demand, it is geological depletion. Mining legend Robert Friedland laid out an arithmetic problem that is terrifyingly simple. To sustain 3% global GDP growth over the next 20 years, even without considering full electrification, the copper we need to mine in the next 18 years must equal the total amount humanity has mined over the past 10,000 years. This is an impossible task. We consume 30 million tons of copper annually, yet only 4 million tons are recycled. The annual gap is 26 million tons of new metal. However, discovery rates are plummeting, and ore grades are declining. We're trying to squeeze blood from a stone. The global South is no longer willing to sell resources cheaply, and resource nationalism is spreading in Panama and Chile. On the political front, President Trump's recent 50% tariffs on copper imports have changed the game. Tariffs build high walls and create a two-track pricing system. But tariffs can't conjure metal out of thin air. They only increase the cost of accessing scarce resources. The material shortages predicted by SP Global isn't price speculation, it is betting on whether the lights will go out. The era of cheap energy and cheap materials is over. We're entering an age of hard asset scarcity. No, let's zoom out to the geopolitical chessboard. While the West has been busy financializing the economy, building derivatives on top of derivatives, the East has been busy controlling the physical atoms that make up the modern world. Pricing power is undergoing a dramatic divergence. Look at Shanghai silver is trading above $115 an ounce. In the West, it is still at $103. That $12 premium is the pricing of physical reality. The Shanghai Gold Exchange is draining physical metal from the West. They're bidding higher because what they want is the metal itself. Not paper contracts. China no longer plays by the old rules. They've realized that in a world where trust has broken down, whoever controls the supply chain holds the chips. Look at lithium prices have tripled since November 2025. The lithium winter is over. Why? Because China controls the bottleneck. They may not own all the mines, but they control 60 to 70% of global lithium chemical processing capacity. Then, look at copper. China imports 60% of the world's copper ore and consumes 58% of global refined copper. But the deadliest and least discussed restriction is happening with a metal that is probably not even in your portfolio yet. Your life depends on it. Molybdenum, it is the element that makes steel hard, the backbone of pipelines, jet engines, and defense infrastructure. Without it, you can't build a modern military or energy grid. China produces 45% of the world's molybdenum. And just recently, citing national security, China imposed strict export controls. The result: China's molybdenum exports to the West plummeted 95% in 1 year. This is a blockade. This is a silent siege on The West is sleepwalking into a supply shock that will make the oil crisis of the 70s look like a minor inconvenience. We optimize supply chains to the extreme of just in time, assuming free trade would last forever. But that assumption is dead. We've now entered a just-in-case world, a world of hoarding, a Great Divergences world where only physical assets in friendly jurisdictions count as safe. So in this bifurcated world, how do you allocate assets? The most common question I get is, did I miss this trade? The CEO of Scottsdale Mint answered it perfectly. This isn't a trade. This is a fundamental shift to a new monetary system. But you can't just buy an ETF and pray. You need specific strategic exposure, looking for assets in geopolitically safe zones within this weaponized mineral space. That is why I am analyzing this entity today, Vanguard Mining. I am not bringing up this name on a whim, but because their asset portfolio perfectly mirrors the macro logic we just laid out. They're not looking for just one metal. They've locked down a critical minerals basket in the Western Hemisphere. Their strategy is essentially sovereign jurisdiction arbitrage, positioning assets entirely in US-friendly regions, Canada, Paraguay, and Argentina. Let's deconstruct their hand through a macro lens. First is the energy hedge Paraguay's uranium. We know nuclear is the only baseload solution for AI and electrification. Vanguard owns the UD project in Paraguay, covering 90,000 hectares in the Paranfay Basin. The key is, it is right next to the multi-billion-dollar market cap giant Uranium Energy Corp. Geological structures don't respect property lines if UEC has ore there. Vanguard's potential is asymmetric. Second is the lithium play Argentina's Positos. One project, since China has a chokehold on processing. The West desperately needs independent supply. Vanguard very shrewdly reclaimed 100% interest in the project without paying any additional costs. This gives them a fully autonomous asset, right in the heart of the most productive lithium triangle on Earth. Just as lithium prices are doubling in a rebound. On the inflation shield front, they have the Brussels Creek project in British Columbia, Canada, a gold-copper palladium deposit located in the Kamloops mining district, right next to New Gold's mine. This is a jurisdiction with solid rule of law, a call option hedging against CAD and USD devaluation. Finally, and most critically, the strategic pivot, the Redonda project. This is a copper moly project. Remember when I said China cut off 95% of molybdenum exports? That move instantly turned moly deposits outside China into strategic-grade assets for the Western world. Located 40 kilometers northeast of Campbell River, this project is not only easy to mine, but also a strategic reserve. Vanguard Mining isn't just a mining company, it is a diversified holding platform for an age of scarcity. Gold hedges currency risk, uranium serves as the energy foundation, lithium powers battery technology, copper and molybdenum form the bedrock of industry and defense. All of this spread across 3 secure jurisdictions. This creates anti-fragility. Most investors are paralyzed right now, staring at $5,000 gold and $100 silver in bewilderment. They're wrong. The shift from financial assets to hard assets has only just begun. That is where the leverage is. We're living on a powder keg. Geopolitical friction is heating up, the bond market is casting a vote of no confidence in the dollar, and the physical supply of copper, silver, and strategic metals is hitting a thermodynamic wall. The debasement trade is no longer theory, it is the dominant force in global markets. We're transitioning to a new monetary system, one backed by atoms rather than promises. The volatility you are seeing, silver's surge, copper's spike, that is the sound of the old system falling apart. You have 2 choices: stay in the paper world and pray the Fed can print copper, print gold, or find your place in the physical world. Embrace what is finite, essential, and increasingly scarce. Do your own due diligence, study the drill results, study the jurisdictional risks, but don't ignore this signal. The math is set. The timing is yours. Stay hedged.